European and UK equities have outpaced their US counterparts, and some fund managers believe that Europe's bull run represents a rotation out of US assets. So, what's the outlook for the rest of the year? To discuss this and more, I'm joined by Mike Field, Chief Equity Market Strategist EMEA at Morningstar. So, Mike, what is your outlook for European and UK stocks for the second half of this year?
So overall, I would say it's pretty mixed, but tilting towards positive, Christopher. So on the one hand, you have markets that are in Europe hitting all-time highs at the moment, which, is a bullish sign for markets generally, but also there's the question of where valuations are behind that. Thankfully, we still see some upside to European markets. So we think equities in Europe are trading at around a 5% discount, slightly more in the UK. So at least that gives us some headroom to grow in the second half. If indeed the outlook is positive, the earnings season comes through for Europe as well, there is still a little bit of room for growth, which is good to hear.
And do you believe that rate cuts in the UK and Europe are inevitable in the second half of this year?
So I think two different scenarios there, two different areas, if you will, right? We speak in the UK and Europe as if it's one, but when it comes to interest rates at the moment, there's a huge differential between the two. UK interest rates are trading at, twice what they are in Europe at the moment. So in terms of expectations, okay, both could see interest rate cuts, most definitely. But I think in Europe, the difference is the ECB are at or around where they kind of want to be, that neutral rate of interest that keeps inflation at or around 2%. In the UK, they've still got a large headroom in terms of cutting. So you should see kind of harder and faster cuts from the Bank of England over the next 6-9 months than indeed you're going to see from the ECB, who they've done a lot of the work already, if you will.
I also want to get your perspective on, in the introduction, I mentioned the rotation out of US assets. Many fund managers are arguing that US exceptionalism is dead. Is that something that you agree with? And do you see this rotation continuing into the second half of the year?
So the answer is to some degree. I think certainly what investors have woken up to over the last number of months is that putting all your eggs in one basket, the US basket, can be somewhat foolish or can lead to a lot of volatility, as we've seen with the April Liberation Day tariffs, right? And I think that was the catalyst for a lot of investors to move more cash to Europe and kind of acknowledge that, yes, it makes more sense to be diversified and indeed have some European exposure. So suddenly that strategy is paid off. And I think investors are very much going to keep that in mind as we move into the second half. That doesn't mean that they're going to ignore the US. It's still the largest equity market in the world by some share. So it's still going to see inflows. But I think, Europe's definitely an option now for a lot of investors, and that wasn't the case before. In terms of US exceptionalism, we can't replace the Mag 7 in Europe. We have nothing of that ilk. So I think, yes, to some degree, you can see outperformance in US tech, or the growth potential, at least in US tech, is still there, certainly. But one differential maybe is what's driving the two economies. And in the US, you had Bidenomics and debt and things like this driving it. And perhaps what you're seeing now is the effect of tariffs maybe constraining the US economy a little bit. So from a growth perspective, can the US grow at the same rate it's been growing at for the last decade or so? That kind of take on US exceptionalism might need to change over the next coming months.
And what's your view on how European and UK companies are playing the AI trade? You mentioned that, we're very far behind the Magnificent Seven. But are you seeing any innovation as, AI is effectively taking the world by storm?
I would treat the whole AI growth as more of a global phenomenon, right? In that, yes, you mentioned the Mag 7. Obviously, they're at the very forefront of spending and development on the AI front. But it's that whole tier of companies underneath that we've been on earnings calls with, huge numbers of companies saying, yeah, we're integrating AI into our processes, et cetera, et cetera. But I think what a lot of these companies are discovering is perhaps they've been too early in adopting AI technologies, and that the returns they hope to get from these technologies aren't there yet. Yes, they will come down the line, but I think the uses of AI in day-to-day life and in day-to-day companies' operations and processes have been overstated at this point. So what you could see indeed is continued spending by the likes of the Mag 7 on AI development, but a slightly more skeptical outlook by companies, doing day-to-day businesses, that they realize that AI isn't quite where they need it to be to actually revolutionize their businesses as of yet.
And finally, Mike, I'm quite interested in your views on infrastructure spending. In the first half of the year, we saw Spain have a massive blackout. We've seen discussions around Germany reforming its debt brake, which is going to kind of unlock so much money to invest in infrastructure and different projects in Germany and throughout Europe. So how is infrastructure, what's going to happen in regards to infrastructure in the second half of the year? And which companies do you think within Europe are going to benefit from increased spending, in particular utilities?
So we're quite excited about the German infrastructure defense fund that, look, on the magnitude of it, if you look at relative to Bidenomics and how far the Inflation Reduction Act went to actually stimulate the US economy, the German bill has the potential to stimulate the German economy to a huge degree, and indeed the broader European economy as well, right? We are quite integrated when it comes to infrastructure. The firms that are, kind of central to Europe in terms of infrastructure, data center, renewables, things like this. They're very much not just national firms, but pan-European firms in terms of the business that they do. So I think the hope is here that infrastructure spend could go far and wide. And indeed, you mentioned Spanish blackouts. Ultimately, that was a huge wake-up call to governments, certainly, but also utility industries in terms of how much they need to spend over the coming decade to upgrade things like the grid. So we've come from a place where we've had kind of a de minimis amount of renewable energy to a point at which in many countries it's quite significant nowadays. And the grid really hasn't caught up with that yet. It's still geared up for old school energy usage, right? Not the kind of volatile renewable energy levels that we're generating nowadays. And now it really needs to catch up, and firms and governments need to spend big on the back of that. So I think there's definitely hope that could provide the backbone for European growth, in the decade to come.
Thank you, Mike. This is Christopher Johnson for Morningstar UK.